Okay, our next speaker should get a lot of interest as well, and it has to do with the economics of fertilizers and product limitations and so forth. And Bryon Parman is an agricultural finance specialist at NDSU. And as a former employee and graduate of NDSU, I'm always obligated to say 9-time NCAA champion. So
not so much this year.
Yeah, well, we had to let South Dakota State win a game or two once in a while, right? So please welcome Bryon.
Thanks.
Thank you.
You got it hooked up? Yeah. Well, this is my first time in Mankato and pretty much mostly in southern Minnesota. I don't get down this far south very often. I suppose I got to stay in front of the microphone. I tend to pace around. So yes, I'm an economist, pretty much a production economist at NDSU. If it's not crop marketing or livestock marketing, I wind up doing it. So it's just kind of a catch-all for everything else. And there's been a lot of talk about fertilizer prices in the last 18 months or so, pretty much since not this last fall, but the one before that, when we really saw fertilizer prices climbing pretty fast. And so just a quick outline. How long do I have, by the way? So I'm 150. Is that what we're calling it? I'm an extension economist, so staying on time is extremely important to these talks. I got a lot of practice doing it. And so I'll give you a quick outline, just some production cost comments on where we're at, because some of the things going on with fertilizer prices wind up being impacted by other costs, right? One of the things we're dealing with last spring as well as this spring is it's not just fertilizer costs that have really taken off. Machinery, fuels, chemicals, seed costs, everything pretty much that we deal with is a lot higher than it was in, say, 2021 as we headed into that spring year. So this is just an index basically from USDA showing prices paid for farm and non-farm type of expenses, which includes everything from health insurance or whatever to machinery, fuels. And one of the things you notice, pretty flat from about 2016 until, like I said, start of 2021. And then it's been just a straight shot upward for the indexes for all of our production costs in farming. Here's machinery prices, for instance. And yeah, I know we're going to talk about fertilizer in a minute, but it's important to know where we're at. Starting in 2021, first part of it, it's been pretty much a straight shot upward. Right? Any of us who've priced or looked at both new and used machinery have seen those prices skyrocket. And in fact, a lot of our producers in North Dakota, for instance, you go, you buy a new piece of equipment, you pay for it in September and take possession next July, you hope. I mean, that's kind of the situation. So if you need it now, what do? You go look for a used one. Well, if 10 of us in the room of 40 all need a used one because we need it now, then we go bid up used prices, and used equipment costs wind up going up pretty dramatically. And then chemicals. One of the conversations last winter was what? Shutdowns in phosphorus production facilities for like yellow phosphorus in China, things like that. Well, those products are used to create things like glyphosate, glufosinate, right? We're worried about shortages in some of our chemicals. You know, if you used a Liberty type product or something like that, were you going to be able to get it? Turns out we were able to get it, but at prices that were a little bit of sticker shock. You know, I saw things as common as 2,4-D selling for $40 a gallon. I mean, that's pretty high for 2,4-D. Liberty up to like $120 per gallon, and glyphosate $85, $80 a gallon at times. So those were way higher than we were used to paying. And we can see there's some of that price has come down a little bit. A lot of that's had to do with a bit of easing on supply shortages, but obviously nowhere near where they were when 2021, when we started the year, right? Where they were versus where they're looking right now. Still a little bit lower, but not considerably. And then we had land values shoot up. And yes, land values and rents are a production cost, right? Because we do have to pay for those, even though they're an asset. And we didn't see rents climb. And I do a lot of land values talks. So I'll give you the Cliff's Notes version of a 1-hour talk. Land values skyrocketed last year. I think they'll be up again this year, but although not 15% nationally, that was national. Each state was slightly different. The big one, the surprise though, rents didn't go up much last year. Not a lot. I think that's probably about to change. So this is a fertilizer talk. We won't go into that. Diesel. We saw diesel prices up around $4.75 a gallon for off-road diesel last spring. Now it's closer to $3, which is quite a bit higher than the $2 we saw headed into 21, but still $1.75 or so below where those were when we started last spring. So I'm showing some relief in some of these products with everything except machinery and seed, but I don't have a chart for seed. So it's been a bit of a mixed bag so far in what we're seeing going on with these production costs. So now we move on to fertilizers. So this chart is the cost per pound of N for 4 different products. Now I do work at NDSU, but my family farms, I'm originally from Southwest Nebraska. We do a lot of irrigation. We put on a lot of UAN 28 and 32, pump it right through the irrigation systems. I know more and more up here, and you guys are using, and I got a chart that shows it, probably a little bit less anhydrous, more urea anymore than had been used in the past. And in North Dakota, we use mostly exclusively urea for the most part. What's the problem with that? And where we are in Minnesota and North Dakota compared to the rest of the country with some of these products and the concerns with things like seasonality and potential shortages and logistical challenges, we're the last ones to the dance when it comes to putting on fertilizer, right? They start planting in Texas and the Mississippi Delta area. And I used to work at Mississippi State University before I came here. So they start planting in February. Right. So, and the access to the barges that come through New Orleans with a lot of these products, easy access to it. We got to get it upriver. They get all their product before we do. They're already planning before we do, and we're at the bitter end. Right. So any of the logistical challenge that anybody heard about the barge trouble with some barge traffic this spring on the Mississippi? They were out dredging it, so you'd have one lane, right, of traffic going through there. It's not good news for us. But hopefully some of this runoff and everything makes some of that travel a little bit easier. But bottom line, so we've got these. This was when I was working on my PhD at Kansas State. It was right around this period, and I was actually doing some research on anhydrous production and some different methods. And we were looking at these nitrogen prices like, wow, these are historically high, and they were at the time. Those were historically high. You had anhydrous costing around 50 cents per pound of N per ton. Urea approaching 90 cents per pound of N. And at the same time, we had really pretty strong commodity prices during that period. You know, $8 corn around that, $14 beans and whatnot. Well, this is now, and this was then. So you can see we're considerably higher than we were during that period of time when there were some concerns about how high some of these fertilizer costs were. And then the chart on this one, I'm going to show a few of these charts, and what you want to look, this gray dotted line is a little bit hard to see, but that's the 5-year average national price. This chart's potash, and it's around $450 per ton. That's the 5-year average. Right now, it's around $700 a ton, and last year it peaked at close to $900, approached $900 per ton. So around double for that specific nutrient. Anybody know where we get our potash in the US? Canada. Yes. We import just about 100% of the potash that we use. Not quite, but pretty close. 75% of that comes from Canada. The rest comes from various sources. So good news with that particular nutrient is that we do import almost the vast majority of it, but we get it from a source that's nearby that we obviously have a good relationship with. The bad news, we are subject to the world price. So if other countries who maybe have a little bit less reliable source, maybe because of a conflict in Eastern Europe and Russia, if something like that were to happen and it disrupts that, drives that world price higher, and then our distributors, Mosaic for instance, they can either sell on the world market at higher prices or they sell to us. So we're subject to the world price, even though our supply is fairly secure, right? Here is urea and starter. Okay, so this is what's happened with that. Urea last spring peaked at just over $1,000 a ton. Okay, and there's some seasonality with these fertilizer prices. When is fertilizer typically the cheapest in a year? Fall, right? Comes down in the fall. It's easier to get it shipped if you need it. You can book it, whatever. And then as spring approaches, it tends to increase, right? And it increases all the way through about April, May, and then you head back down. And that's kind of what we saw happen. It's just that the peak was over $1,000 a ton before it started trekking down for urea. The 5-year average urea price in February, March is usually around $500, $490-ish. Last year, it was 900 plus, peaking at 1,000, and right now it's around 700. Okay, so it is down, but nowhere near the 5-year average. And that 5-year average is actually increasing because, you know, when you include a year where it's $1,000, it tends to pull that average higher. Nonetheless, 480, 490 up to 700 right now heading into the year. And we probably would expect that we're going to see, as March and April approaches, that urea price is going to climb. If it just follows the typical seasonal pattern. Okay. And then starter fertilizer, same story. It peaked at just around $900 a ton. That'd be 1034.0. Okay, right around 900. Right now it's around 750, and that 5-year average is just over $500 a ton. Okay, so down again. Moral of the story with those two: down compared to last year, but still way above the 5-year average, as much as 50% or more higher than what we expected to pay. So compared to what we were paying in like 2021. 50, 60% higher on those. And then our phosphorus products, DAP and MAP. Okay. Again, those products peaking last year at over $1,000 a ton in the spring, that April timeframe. Right now, both of them are around $850 a ton. Okay, so 15 or so % below the peak from last year-ish. But then that 5-year average price on those is around $560, $575 a ton. So last year is around double the typical cost. Right now, you know, about $300 a ton higher heading into. But again, you might expect that those are probably, because of seasonality, going to increase a little bit as we head into spring. And I got a lot of questions about, should I, you know, when fertilizer has been coming down like it typically does in the fall, and because we have some atypical circumstances that have caused, that we'll talk about here in a minute, the prices to be where they are, a common question was, do I go ahead and book fertilizer, you know, now or maybe a month ago when those questions were coming, or do I wait and see how far it'll slide and then go ahead and book it? And right now, it doesn't seem like there's going to be a whole lot more additional slide. We're going to start with that seasonal upswing. And, you know, that's the only guide we really have right now. And one of the big movers in the room would be, how confident are you that some of the conflict in Ukraine and Russia is going to be resolved soon? I don't know. I mean, I'm not a political scientist, but the bottom line is that's weighing heavily on that. And we'll talk about more, we'll move on to that here in a bit. So this just shows the national fertilizer prices from last week. There haven't been a ton of sales, so this is just going like Anhydrous was $1,223 nationally, closing last week per ton. Urea almost $700, $698 a ton nationally. Potash $7.5, and MAP and DAP around $850 a ton for either your flavor that you choose. So that's kind of where we stood last week. Here's one for Minnesota. Now, we don't have a lot of sales yet in Minnesota. In North Dakota, we've got almost pretty much none. We don't have enough data to even compile this. So take this with a grain of salt, because there isn't a lot of observations. But Anhydrous up here was around $1,400 with the few sales that happened. Urea $850. And MAP was $910, so more expensive than the national average right now. Probably a lot of that due to logistics of actually having it. Now, I do know a lot of our co-ops in North Dakota have the fertilizer in the shed ready to go, which is pretty much already bought. But we also know what, there's going to be some late application, potential side dress, things like that that go on. That's when those prices really creep up and wind up higher during the course of the year, right? And so this chart, because I'm an economist, I have to make a table with a lot of numbers you guys can't read. But what it's basically going to show is everything in red is going to be a little bit higher projected by the USDA from last year to this year. And everything in yellow is slightly lower. What do you see? A mixed bag, right? You got some that are a little higher. For instance, seed, fertilizer down a bit, chemicals down a bit, fuel and lube down, electricity, et cetera. Capital recovery down some, interest double, but we're doubling from a low number. So not the biggest deal. But by and large, what the expectation is from the USDA, last year's production costs are going to be slightly higher than this year's, or this year's slightly lower than last year's. Not a lot, even though we are getting a reduction in some major items like fertilizer, and we're going to go on to talk about the outlook of that here in a minute. But things like equipment are eating up a lot of those cost savings from last year, right? Some of the dealers or folks that I'd talked to, as well as dealers, were saying, you know, from like October, that September, October timeframe last year, there was like a 13.5% increase that they baked in on the machinery side from that. So anybody who's looking at pricing maybe this spring are going to be a bit surprised if they looked last fall versus what we're seeing now. All right. So we're going to talk about some of why fertilizer prices did wind up going up. So we know that they are and that they have, but now get into the why and if what we see going forward. How am I doing on time? Not bad. 10 minutes. I thought it was going to 150. Oh, all right. So what's happened with commodity prices, right? This is corn, wheat, cotton. Why did I choose those three crops? Big nitrogen users, big fertilizer users, right? And when I worked at Mississippi State, like we never saw cotton prices, for instance, at 90 cents to $1 a pound. They were struggling to get to 60. And the last time we saw wheat prices at $7, $8, $9, $10. Anybody in here raise any spring wheat? A little bit? Too far south. Well, we raise a little bit in North Dakota. How about corn though? A few acres, right? I'm from Southwest Nebraska. I didn't know there was another crop. There's corn and corn and sometimes corn. So commodity prices have been strong and they really got going about that middle of 2021. When we came into 2021, we had about 5-year average production costs. We were coming out of a pandemic. Commodity prices took off through the summer of 21. There wasn't a global conflict going on. And a lot of our energy costs were, you know, around average-ish. And so we started the year at low costs, commodity prices took off, then we head into the fall. All of a sudden, things prices for things like fertilizer and everything started taking off. A lot of that had to do with logistics and issues acquiring components in the production of fertilizers, plants being shut down due to COVID in places like China, where if they had a big outbreak, they might shut down a factory or a plant for weeks, you know, because they had pretty strict rules on things like that. And then we had these higher commodity prices. And you can see it here. Prices, this is prices paid, the blue line, the red line is prices received. Pay no attention to the fact that prices received are lower than prices paid. That's just how this chart's indexed. The key takeaway is the gap between the two closed. All right, so prices received began to exceed the rate that prices paid were increasing. So we had an increase in commodity prices, especially corn and wheat for our case, which are big nitrogen users. The other thing, despite these high costs, and remember heading into last spring, yes, we had strong prices, but everyone was worried that these costs were going to eat up incomes, net, right? We're going to have high gross revenues, but net revenues may not be so strong. Well, it turns out 2022 is looking like, or at least USDA projects, is going to be better than 2021. In fact, net farm incomes for 22 are going to rival, and this chart's by the USDA is adjusted for inflation, some of the better years from like 2013, right? So what do we remember happened 2008, 9, 10, after the EISA mandate happened to things like equipment costs and fertilizer prices and everything else? We had record net farm incomes, all the production costs wound up going up with it. So it's not just a global situation going on causing this in conflicts. It's also the fact that incomes in ag are some of the highest in net that we've seen in a long time. And with that, production costs tend to maybe lag it by a year, but go up and increase. And then we look at commercial fertilizer use in the US. And I know that we got some plant scientists in here. Yeah, maybe. Yields per year, our average per acre yield on a lot of these crops has increased, right? And to be sure, the crops that we're planting are more efficient in the use of the nutrients that we put on. But at the same time, there's no such thing as something for nothing. And so if you want to increase, that's one of the things we believe in economics, no such thing as a free lunch. If you're going to increase yields and increase the amount that you'll wind up taking off, you're going to have to put it back in the form of fertilizer usage, right? So if we look at commercial fertilizer use in ag by nutrient, now 2 of the common fertilizers we use really haven't increased much since the 80s. Things like potash and phosphorus have actually stayed pretty flat nationally in terms of the amounts we use. Nitrogen, on the other hand, has kind of really increased pretty remarkably right before 1980. And this is a study done by Texas A&M. But it's been a steady increase year over year in nitrogen use in the US. Now, part of that's crop selection, right? If you change over from something that uses less fertilizers and you shift into more corn acres or something like that, then that's going to have an impact there. So that's part of it. But then the other part of it is the increases in yields, and the productivity in the plants requires more of those products be applied, right? Here's one from the that I had this emailed to me. I figured out how to get these graphs off. Minnesota's Department of Ag 2020 crop year fertilizer sales report. Total fertilizer sales in 2020 was the highest in this 10-year period, and you can see it's been a steady trend upward. So Minnesota as a state's using more. This is just overall fertilizer, any type, increasing. Now, if you look at nitrogen sales in Minnesota have been, they're kind of following that national trend of steady increases in nitrogen, right? Now, as a state, you guys are using less anhydrous. Anhydrous tends to be the cheapest per pound of N product there is, but it's also obviously the most difficult to handle and deal with, and you wind up with some losses from it. And then an increase in a bigger increase in urea. So you got this increase in urea used. Now, as far as domestic production of nitrogen goes, we are importing less than we have in about the last 5, 6, 7 years. Okay, so the way to read this chart, when you look at it, the gray bar there, okay, and that's used over here. That's the percentage that's imported. Okay, so as that's getting smaller and smaller and shorter, is showing that we're importing less and less of the nitrogen or the ammonia we actually use in the US, to the tune now that it's getting less than 10%. So we produce, and I've read reports that say we have the capacity to pretty much produce all the ammonia that we need, right? It may be less efficient that, in some cases, efficiency declines as production increases if you get to a certain point. But by and large, we've increased production capacity in the US even though we've had an increase in usage, we're less and less dependent on imports, okay? So one of the things though in the industry, the nitrogen production industry, at least as far as the US goes, so in the same report, they talk about what's called a four-firm index. So how much of the market does a small group of producers control? Okay. So four-firm index is around 75% of the nitrogen or the nitrogen fertilizer market in the US is controlled by four companies. All right, CF, Nutrien, Coke, and Yara USA, 75%. And that's, as of 2020, that was 32 plants in 17 states. And for those who are into IO, the HHI, Herfindahl Index, it was around 2387. If that doesn't mean anything to you, it's fine. It's just that basically anything over 2500 is considered highly concentrated. Anything, and if you're less than 2500 but greater than 1500 as an index number, that's moderately concentrated. It's closer to highly concentrated than it is to moderately concentrated, is what this is saying. All right, so there's a few firms who control the vast majority of the nitrogen in the US. Now, kind of on a global scale, so talking about this, the World Bank put out a report about 3 weeks ago-ish. 70% of the ammonia production capacity in Europe had been shut down due to high natural gas prices. It just wasn't efficient. High natural gas prices spiked. I got a chart that shows that here in a bit, but they'd shut them down because of high prices. The expectation is that here soon that those are coming back online, and so Eastern European production should be, or European production should increase. Why is that important to us when we produce just about everything we need? Again, we're subject to that world price. So if a bunch of plants shut down in Europe, that drives the world price up, and we wind up paying more for stuff even though it's produced domestically. Why? Because you could always sell it on the world market if US domestic prices are so much lower than the world price, right? It's a globally traded commodity. And though there was that conflict with Russia and Ukraine, and there were fears about some of these supplies being a problem, there was a carve out in some of the sanctions that were put on that allowed for fertilizer exports. And that's important because if you look at urea, Russia exports around 15, 18% of the world's urea. That's a lot for one country to be supplying to the world market. Okay. And look at ammonia. Russia's the blue, all the blue on the bar for ammonia, for instance, supplies over 30% of the world's market for ammonia. So if there was a concern that was going to be wiped out because of conflict or reduced dramatically, that's going to have a big impact on people going to the world market, especially countries like Brazil and Argentina and India, who use a lot of these products but don't produce enough. They don't produce nearly the quantity that they use compared to us, right? Drives up world prices, hence we wind up paying more. And then don't forget about China. So the blue line is 2019 to 2021 million metric tons of exported fertilizer products from China. The red line is 2022. A lot less. Key takeaway from this chart. China exports 30% of the world's DAP, and it fell by 50%, and urea exports fell by 60% last year. So again, you have a lot of things going on that are causing these fertilizer prices to increase. At the same time, you've got high commodity prices. And then we talk about potash. Producer Mosaic said stockpiles were too high to restart. This was an article that came through, restart some Canadian mines for potash. So I said that they were where the prices were, and until prices wind up recovering, there's some capacity that could have been increased or had been adding some of this product to the market that was chosen to basically shut down, suspend operations for a little while to help support prices. Now, when I was doing my research at K-State, one of the things that was, it's a critical component in the production of anhydrous, and that is natural gas. Okay, so typically natural gas prices and ammonia prices, fertilizer prices, tended to move together. Okay, so you look at this chart, and you can see the blue line is anhydrous, and the red line is natural gas production, and this again came from a Texas A&M study. But usually when there's a spike in natural gas prices, you see a subsequent spike in ammonia prices, right? Sometimes they're not one for one. Sometimes that relationship is either greater or less than another. But by and large, there's a relationship there. But you could see here at some points, we actually had a drop in natural gas prices in January 10th, 11th, 12th, and 13th, but a big increase in anhydrous prices. Why? High commodity prices. All right, now let's look here. Here's natural gas prices, and they did spike. Now they weren't up as high as they were in like 06, 07, 08, but they did increase. And then this is what anhydrous prices did. A big upshoot, one of the highest increases in history. Now, if we remove the price, they did a chart where they removed the price of natural gas from it. So saying, okay, we're going to take out the natural gas impact on anhydrous prices. And here's how anhydrous moves compared to the price of corn. Pretty close. I mean, we do a lot of correlations and lag models and things like that, but I can eyeball this and say that that's pretty good. Pretty good tracking, right? So what does that tell you? Anhydrous is natural gas prices are a factor. I mean, that's one of the biggest input costs there is. But commodity prices also play a role in this too. And you can see that from there. Then finally, one of the things I wanted to plug when we're talking about this, and I don't do the yield response type stuff at NDSU. We have a soil scientist, Dave Franzen, who does this. Maybe some of you guys have heard of him. This is the old, when we're teaching farm management to students, the old nitrogen response to fertilizer. And what you notice about this, and this is what I would always teach my students, and you guys know this, but for the first few pounds or first 50, 60 pounds of nitrogen you add, you get a big boost. And then the more and more nitrogen you add, the lower the boost gets. And if I kept tracing this out, eventually it'll go completely over because you'll burn it up and kill everything. And then you've got high versus low productivity soils. That actually how this goes through. So in a high productivity soil, you can continue to add nitrogen for longer and get more yield out of it. Lower yielding soils, you have a lower potential, right? You eventually have to cut off nitrogen supplies sooner because you wind up losing, you wind up not getting the benefit out of it. So what we do at NDSU is we put out these charts. And essentially what it shows is, depending on the price of corn per bushel and the price of nitrogen per pound of N, you can decide on sort of an optimum pounds of nitrogen per acre that you intend to apply based on the price of corn versus the price of nitrogen, right? So I know this doesn't apply, so it's just an example for this region necessarily. But for instance, if corn price is $3 a bushel and nitrogen prices are 60 cents a pound to N, you would apply 38 pounds. Simply because as they say, the juice isn't worth the squeeze after that. You're actually not getting enough yield out of it to justify the additional pounds of N that you would be applying. On the other hand, if corn price is $10 a bushel, you can apply until you're up to the point that you're not killing it, and you'd still be good to go. Right? You'd actually be making a profit out of it. In other words, max application, whatever that is. And this is a challenge we as economists kind of deal with once in a while, in that maximizing production and maximizing profits are not always the same. They're not necessarily the same thing. I get in those discussions sometimes with the livestock guys about the heaviest weight cattle are not necessarily the most profitable. Right? Same thing with this. So this would be a higher yielding area. So in this case, you can obviously see it. At 50 cents a pound of N and $10 corn, you'd put on 270 pounds. At $6 corn, you'd put on 250 pounds. Right? So maximizing. So those are things that think about. And there are plenty of calculators where you can put in your APH, the price of corn, and the price of fertilizer per pound, and come up with some of these figures yourself for whatever your yield happens to be in your area, right? They're out there. And it just gives you an idea on how to think about that. And do I want to try to get, if it boils down to, if I have to add another 25 pounds, for instance, to get another 5 bushel, but it's 60 cents a pound, and the price per bushel is $4 or $3 or something like that, it doesn't make economic sense in that case. And I got one for now, because what do they say in commodity prices? What's the cure for high prices? Same thing's true in fertilizer to an extent, right? There's a lot of new plants that are projected to be built, not just by US manufacturers, but abroad, right? Projects that may have been scrapped. Like there's one in Brazil where they started construction a while ago, then they stopped with about 3/5 of it finished. And then all of a sudden looked at over $1,000 a ton anhydrous and said, you know what? We're going to go ahead and finish this kind of down near the Mato Grosso area. Plants in South Africa, countries like India are building all kinds of plants, although I think they just had one blow up. I'm not sure that'll deter them. I think that they're going to keep on moving forward with that. But the bottom line is the cure for high prices is high prices, that eventually a lot more plants are going to come online. Other companies are going to take advantage of some of the profits that have been gained over the last 18 months. And we'll probably see some of these fertilizer prices trending down. But I put this chart in here again, simply because the last time we saw nitrogen prices this high, how long did it take to get to where we were in 2019? So we were here like the better part of 6-7 years. I mean, these plants, these increases in production don't happen overnight. Years and years and billions of dollars in investment to increase capacity, excuse me. And then if you look at the USDA's projections for net incomes going into the future, surprise, surprise, they're expected to decline for the next 3 to 5 years. That shouldn't be a shock to anyone. If anyone's looked at net farm incomes for agriculture or been in farming for any length of time, what do we know? Looks like this, right? We've got periods that are really strong, 2010, 11, 12, 13. Then we head into 14, 15, 16, 17, 18, 19, right? Then we get a strong period. We start moving up 20, 21, 22, hopefully 23. Then probably at some point, there's going to be some kind of downward swing in incomes, okay? And it facilitates some of what goes on here, not to mention the increase in plant capacity and production capacity that's going on right now. So there's a lot to unpack with what's happened in fertilizer pricing in the US and abroad. We had sort of a whole log jam of things that all occurred at the same time. Logistic challenges coming out of COVID, plant shutdowns, shipping ports that had 25 container ships sitting off there waiting weeks to be offloaded with certain products that happened, plant shutdowns in overseas, et cetera, trucking shortages, not to mention the fact then we have commodity prices spiking, we have natural gas prices increasing, and all of that occurring at the same time to drive fertilizer prices to where they are. So it's going to take some time to bring some of that down, right? And it did last time and it wound up occurring. I think that it'll probably occur again, that we'll see a decline, but I'm not going to venture to say when. I try not to prognosticate because my likelihood of being wrong is high. Like one time, after we got the first MFP, I said there wouldn't be another one. Then after we got the second one, I was pretty sure we were never going to see another one. Then we got CFAP and I just quit trying to make claims about stuff I am probably unqualified. So, how'd I do on time? All right, a couple minutes for questions on anything. Will the political landscape in Canada affect their ability to mine potash in the future? And if it does, what are other sources? I'm not entirely on the politics. I'm not a political scientist per se, so I don't follow Canadian politics that closely, to be honest with you. But I will say this, if there is a situation where a country like Canada decides, or there's regulations put in place to reduce their exports, somebody is going to come in who has the capacity to fill that void. Now, it may be at an elevated price, but yes, countries like Belarus and Russia will come in and fill that void. If the price is high enough, they'll be happy to take up the market share. I know that that's kind of something that they'd certainly be willing to do. Yes, sir. Okay. The viability of green ammonia. I am not 100% sure what totally qualifies as green ammonia yet. I'm learning more and more about it, like blue ammonia versus green ammonia and those other products. So we did some research. I worked with a chemical engineer at K-State on the process by which ammonia was to be created using solar power and desalinization. And believe it or not, I helped design a plant that would actually do that. The viability is going to have to do with the price of ammonia staying high enough. Okay, it always comes down to that. So when I did that study, and it was rudimentary, and actually some of the concepts that are being discussed and have been implemented actually that was kind of some of the roots of it. It really depends on not going to like $350 or $400 a ton anhydrous. If you wind up getting down to that level, the energy sources, as we're all aware of, things like renewables and less CO2 emission stuff, is more expensive. And desalinization, for instance, so that we're not drawing water, for instance, from rivers and things like that in the US that folks are concerned about, that also comes with a pretty substantial cost. So as long as the product itself stays high enough, then those have a real potential to be viable long term. Especially if they stay, at least if they stay high enough for long enough that some of the processes and any little bugs in the process are worked out. Right? Because we know with any new concept, you build the first few factories or first plants, and there's some things that weren't foreseen. They get all that worked out and they get things humming. Then you wind up with a viable industry. I could see it being kind of like an ethanol kind of deal, where it took some time, they got better at it, and as long as the price of fuel and stuff stays high enough and corn low enough relative to it, then it's fine. But you get to a point, if it drops too low, then all of a sudden, especially countries who may not have some of the regulations put on emissions and water usage would have a big competitive advantage if it gets too low. Has the current president affected prices? Yikes. Any policy on trade or whatever obviously can have impacts on a lot of globally traded commodities, for instance. And when you're talking about sanctions, for instance, on different countries that trade in a lot of these commodities, of course you can wind up with price implications from that. Now, I don't know necessarily how much I would be able to tease out one statement, policy, or action from another to come up with how much impact has that had on anhydrous prices. But anytime you put certain barriers on, you can wind up impacting prices. But then the question is, what is the benefit or what is the gain from that? And it's tough to say. For instance, when we had the tariffs and the trade war with China, obviously that had a big impact on prices, especially machinery and equipment. I can show the chart where as soon as the tariff on steel and aluminum occurred, we had a price jump on machinery. So when the sanctions went in on Russia and Ukraine, even though there was not Ukraine, but Russia, Belarus, those other countries, even though there was a carve out, you have a fear in the markets that some of that product may not be able to be supplied, right? And anytime there's a war, you know, you have those kind of concerns. So of course, politics plays a role, but right now it'd be pretty tough for me to disentangle how much, if any, of an impact that actually had. Have I worked with developing the Bakken? I have not. I don't, that's a pretty short-winded answer, but I can't comment on that. And finally, do I feel with the increase in input cost due to the cost increase of products such as fertilizer, is there an increase in, oh, yes. Soil sampling, I almost forgot. We always at NDSU encourage soil sampling and testing, always, always, always. But with input costs this high, it's pretty easy to see how it's going to pay to know exactly how much nitrogen and nutrients you need to put on when you're paying these kind of prices. Sometimes it's a little harder for us to convince folks that that's true, to take the time and the hassle and send these things in to get back a result. But when you're talking about urea at 70, 80, 90 cents per pound of N, right? All of a sudden soil sampling becomes, I can all but guarantee that it's going to wind up saving someone some money in the long run, continuing to do that. So that one's an easy one to answer. Future demand for soybeans with all the renewables. We've been talking about that. I guess I only have time for this last one. That has been something that's been on the forefront. We actually have an economist at NDSU who really knows a lot about soybean crush and renewable diesel sources and oils. And his name is Dave Ripplinger. And he's given a lot of talks on that. So I'll just paraphrase best I can some of his comments. There is going to be this potential increased demand in soybean oils, right? And their uses as a renewable. And not only that, but there's countries in Southeast Asia who don't want the oil, but they want the soybean meal. And they don't have the crush capacity to take in the raw beans, crush them. They use palm oil instead. So they don't want the soybean oil, they want the meal. And then you've got renewable sources who want the oil. So there is a big potential for soybeans in that respect, that we wind up finding some new trade partners for crushed soybeans, the meal that is. And then at the same time, having a lot of these renewable companies who want to buy the oil. So if all of this works, if everything I've been hearing it's kind of optimistic, but we're hoping that it's true, works out, there could be some real opportunities for the use of oil and then exports of the actual soybean meal going to these Southeast Asian countries who don't have the capacity or the want really to crush because they use palm oil. So we got a place for the meal and a place for the oil. That sounds like pretty promising future if some of that comes to fruition. So with that, thank you, everyone.